In recent weeks, the attention of major global media outlets has been drawn to the sudden shift in tone coming from both Beijing and Washington. According to information from Chinese and American sources, China is preparing to announce a decision to suspend trade operations with the United States in the near future. As reported by the reputable outlet Reuters, citing insiders within China's Ministry of Commerce, Beijing is considering a wide range of retaliatory measures, up to and including a complete halt of trade with the United States, unless Washington provides guarantees to lift tariffs and restrictions on the export of rare earth metals. Sources claim that the Chinese side has already notified several major ports and logistics operators to prepare for a standby mode that, under certain developments, could smoothly transition into a full-fledged trade blockade. According to internal documents, the annual trade volume between China and the United States exceeded $600 billion last year, but by October of this year, following the introduction of new U.S. tariffs, the volume of shipments had already fallen by nearly one-third. Chinese think tanks report that exports to the U.S. have dropped by around 27% compared to the same period last year, and in some sectors, such as metallurgy and electronics, the decline has exceeded 40%. China's economy is feeling the strain, but Beijing is trying to project an image of control. State media claim that the decline in external demand is being offset by rising domestic production and expanding trade with other Asian nations, yet unofficial data indicate a sharp drop in port activity. According to the Shanghai Institute of Maritime Logistics, the total volume of container shipments in September fell by more than 18%, while idle cargo terminal capacity reached record levels not seen since 2020. For major ports such as Shanghai, Ningbo, and Shenzhen, this translates into billions of dollars in lost profits, declining freight rates, and growing debt burdens on transport companies. The American measures introduced in early October targeted key segments of Chinese exports, including microelectronics, batteries, electric vehicle components, and rare earth metals. Washington justified its actions as necessary to protect national security and reduce technological dependence on China. But in Beijing, they were perceived as economic coercion and political blackmail. In response, Chinese authorities have not only begun developing their own export restrictions on critical minerals, but are also considering a much harsher scenario: the temporary suspension of trade relations with the United States. According to a source close to China's government apparatus, if the situation does not stabilize by the end of the year, China reserves the right to halt all shipments to the U.S., including energy and industrial goods. Economists note that a potential breakdown in trade would hurt both sides. American companies whose supply chains have been built around Chinese factories for decades would find themselves in an extremely difficult position. Apple, Tesla, General Electric, and dozens of other corporations are already discussing with suppliers the possibility of relocating part of their production capacity to India, Mexico, and Vietnam. But such a move will require time and additional costs that will ultimately fall on consumers. If the tariff escalation continues, the average price of consumer electronics in the United States could rise by 12 to 15%, and that of household appliances and automobiles by up to 20%. Meanwhile, Chinese industry would face the challenge of redirecting vast amounts of production to the domestic market and to Southeast Asian countries, creating oversupply and downward pressure on prices. The decline in trade turnover is already affecting global logistics. Major shipping companies, including Costco and Evergreen, are reducing the frequency of voyages to U.S. ports such as Los Angeles and Long Beach, reporting a 25% drop in cargo traffic compared to last year. According to Bloomberg, the volume of Chinese shipments to the United States fell by October to its lowest level in the past 6 years, and freight costs on Pacific routes dropped by nearly half. This creates a domino effect, from reduced port revenues to losses in insurance and maritime services. In analytical circles, there is a growing view that the trade confrontation between China and the United States goes beyond a conventional tariff war and is turning into a long-term strategic struggle over the redistribution of global markets. China is betting on strengthening domestic consumption and rapidly developing high-tech industries such as microchip production, batteries, and solar panels, while Washington seeks to push Beijing out of supply chains for critical components. In this context, the suspension of trade becomes not just a threat but a real tool of pressure. An analyst at the Beijing Institute of International Economic Studies stated that in the current configuration, China can only win by refusing to play by imposed rules, adding that discussions about partially halting exports to the United States have already been elevated to the Politburo level. On the American market, the reaction is mixed. Some experts believe that Beijing will not take such a radical step, while others point out that China traditionally prepares public opinion and infrastructure in advance, acting gradually. Indirect confirmation of this hypothesis came in reports of reduced purchases of American agricultural products, especially soybeans and corn, as well as the suspension of several joint research projects in energy and aerospace. Chinese state media have so far refrained from direct statements, but the rhetoric is becoming increasingly firm, with references to unfair actions by the United States and China's right to a symmetrical response. Amid rising tension in Washington, concerns are growing that the trade confrontation could escalate into a major economic crisis with global consequences. According to sources in the U.S. Department of the Treasury, if Beijing does indeed move to temporarily suspend trade operations, American economic losses could reach between 0.5 and 0.8% of GDP as early as the first quarter of next year. This would lead to higher prices for raw materials, electronics, and consumer goods, as well as disruptions in supply chains, particularly in the automotive and technology sectors. At the same time, Beijing appears prepared for a long game. According to the South China Morning Post, the Chinese government has intensified its domestic resilience program, an initiative aimed at reducing the economy's vulnerability to external shocks. Under this program, state-owned corporations are required to increase the share of domestic production of components to 85%, while private enterprises are offered tax incentives for relocating manufacturing capacity from export-oriented zones to inland provinces. Moreover, China is already conducting closed-door negotiations with several BRICS countries to create alternative logistics corridors and payment systems that would bypass the dollar in international transactions. This could serve as a prelude to a new economic architecture in which the role of the United States as a key trading partner gradually diminishes. Against the backdrop of all these developments, global markets are holding their breath. Investors closely monitor any hint of a change in Beijing's rhetoric, and stock exchanges react even to leaks from Chinese state media. Although officials from both countries are still avoiding direct statements, more analysts are concluding that China is indeed preparing a response that could become a turning point in the history of global trade. The question is whether China will take this step and announce an official suspension of trade with the United States, or limit itself to symbolic measures, leaving room for maneuver. Everything will depend on Washington's reaction, whether the White House is ready for negotiations or prefers to continue its pressure campaign. But one thing is already clear. Regardless of the outcome, the previous format of economic relations between the world's two largest powers will not return. The world is entering a new era in which economics, politics, and geopolitics merge completely, and every decision by Beijing or Washington can shift the balance of power on the planet.